everyone, my name is Jack. Welcome back to the channel. I cover a variety of topics as they relate to real estate, investing, the markets, and pretty much everything as it has to do with personal finance. So if you like that sort of content, be sure to have a look around the channel, and if you like what you see, be sure to subscribe. But today I want to talk about the mounting foreclosure crisis that real estate as an entire industry is facing, more specifically in the commercial real estate space with commercial mortgage-backed securities. Because the pandemic has brought with it tons of economic strife and struggle, and real estate is not safe from this. And in fact, real estate was one of the first areas hit by this crisis when government shutdowns came in and stopped businesses from being able to come in and then pay their rent in turn. Well, this problem has continued up until today. But before we get into that, I want to explain what a commercial mortgage-backed security is. A commercial mortgage-backed security, or a CMBS for short, is basically a package of mortgages that's put together into a sort of fund, if you want to look at it that way, and then that fund is divided up into many securities, sort of like a company being divided up into stocks. Each of these securities represents the right to collect on that pool of mortgages. So as these mortgage loans are dished out, they bring in revenue from people paying back the mortgages, and people who own these securities then get the revenue from that pool of mortgages as well. A CMBS is a quick way to get a diversified portfolio of mortgage loans across any industry, but especially in the commercial real estate industry, CMBS loans are very common compared to other sectors. And CMBS loans are not without controversy. They were one of the main drivers of the global financial crisis back in 2008 and are certainly part of this crisis that we're facing right now. Although the mortgage-backed security crisis is not nearly at the level that it was in 2008, it is still something that we should definitely keep an eye on since it is a significant problem right now. According to TREP, which does a lot of research on mortgage-backed securities and the real estate industry in general, the 30-day delinquency rate on CMBS loans is actually declining slightly since it hit its peak a few months ago. However, it is not declining quickly. It's declining very, very slowly, and a lot of the decline is actually due to the fact that forbearance programs have been enacted on commercial real estate loans. In any event, between 8 and 9% of all commercial mortgage-backed securities are over 30 days delinquent right now, meaning that they haven't made their payments in over 30 days. But really, these numbers should be much higher than they actually are, but the forbearance programs that we have are currently skewing these numbers in a way and are basically just kicking the can down the road. Now, before I go further, I should actually explain what mortgage forbearance is. In general, it's where a lender decides to give the borrower a chance to not make any mortgage payments during a certain period of time, and then at the end of that period, the borrower would then make up those payments in some way, whether that be spreading the payments out over the remaining term of the loan, putting it all at the beginning of the end of the forbearance period, or putting it at the very end of the loan itself. Forbearance is just a period where you don't have to make loan payments, but it does not waive them entirely. It just kind of kicks them down the road. Now, the government has actually required a lot of mortgage lenders to start allowing forbearance when a borrower asks for it if they can even slightly prove that they have been affected by the COVID-19 crisis, which frankly, is everyone in the country. So technically, if a borrower is in forbearance and isn't making their payments, they wouldn't be counted on this chart that I showed. They're technically in forbearance, which means that they don't have to make payments, so by not making payments, they're not delinquent. However, this is misleading because they will have to make these payments at some point once forbearance ends, because forbearance can't go on forever, because that would mean that the mortgage isn't really a mortgage anymore, it's just a free lunch. However, forbearance is not a free lunch, since like I said, the borrower will have to make those payments up at some point, and in many cases, it actually just kicks in right after forbearance ends. So if you take 3 months of forbearance, in some cases, you're going to have to make 4 months worth of payments in that first month after forbearance. So if you haven't been making much revenue, which unfortunately many businesses and tenants have not been making much revenue during this crisis, or at least compared to before. So if you're not making that revenue, you're going to be in a very, very tough position when forbearance ends. This is why I really consider forbearance in many cases, not all cases, but many, is really just kicking the can down the road and delaying the inevitable. If a business tenant can't make their payments, then they shouldn't be allowed to stay there under their current terms. What ends up happening in the commercial real estate space is oftentimes a landlord might know that if it's a recession, they'd struggle to fill that space if they were to evict a tenant. So what often happens is they work out some sort of deal, and that's what you're seeing with tons of lawsuits right now between tenants and landlords in trying to decide who's actually liable to pay because of all of these government regulations stopping tenants from being able to open their shops and all that great stuff. But really, it's not in either party's interest to go through an eviction, especially when the landlord knows that they can't actually fill the space up with anyone else. So often what they'll do is they'll just cut some sort of deal that changes the terms in some way, usually making it more favorable for a tenant who can't pay under the old terms. And this is because everyone understands the economic situation that we're in. So tenants, compared to before, often have a lot more leverage than they did before. In a period of growth where there's lots of tenants and lots of choices for landlords to pick, there's a lot more competition between those tenants. So often rent will be a lot higher, terms will be less favorable for tenants. But in a downturn, that can quickly change. And now a landlord's going to know that they can't just fill up the space with a new tenant nearly as easily as before in many cases, because demand is much lower. There's a lot less reputable or high credit worthy tenants to actually put in those spaces. So there's a lot less room here for negotiations for landlords. But anyways, that was a bit of a tangent. The point is we have a ton of loans that are currently over 30 days delinquent and haven't made payments for a very long time. And TREP's not sure how many loans are actually in forbearance, but it estimates in the private sector that there's about $20 billion in CMBS loans that are currently in forbearance, so they wouldn't be counted in this delinquency rate. But that's looking at the whole market. If you actually look at specific industries, it is very dire in some cases. For example, retail is looking at about 40% of loans currently in a special servicer status or otherwise are in some special arrangement because they can't make their original payments. And for hotels, it's even worse at 70% of all loans for hotels are currently in special servicer status or on a watch list. So a supermajority of an entire industry, the hotel industry, is currently being crushed or at least extremely pressured by its overarching debt load. Now, obviously, we can't predict the future. We don't know what's actually going to happen, but it looks like this problem is not going to get much better anytime soon. It has slowly been getting better technically, but who knows how much of that is due to forbearance and other things that are just delaying the inevitable and skewing the numbers a lot in the short term. All I know is that this situation is not good, and we're not in a good position because of the amount of debt that's in the real estate system and the amount of people that can no longer pay that debt because tenants can't pay, and then landlords eventually won't be able to pay, and you get this domino effect of pain. Sure, the government can step in and bail it out, as it often does with the Fed printing lots of money, buying up these commercial mortgage-backed securities, but it doesn't really change the fact that the system needs this money to circulate. You can't just print a ton of money and fix the problem. You want fair transactions between tenants and landlords and borrowers and lenders. You don't want the Federal Reserve to just come in and become all of those things. You're not creating anything in that situation. You want an economy where there are transactions where value is created, where one party gets something and the other gets something in return. That is exactly what you want in a system like this. We're at least not getting that as much as we were before, and it's a very delicate system right now that could get a lot worse very soon if something doesn't change. Anyways, I hate to get any more doomy and gloomy. I know the situation's not good. I personally don't think it's going to get much better anytime soon, but there's always a chance that it does, and I hope it does. That would be great, but right now we just have to keep tabs on the situation because it is very threatening to the overarching commercial mortgage-backed security system. And when that system's under threat, it has a trickle-down effect on much of the financial markets and certainly the real estate industry, which plays a very important part in the American economy. But that's all I've got for today. If you guys like this video, please like it since it helps the channel out a lot. And if you like this sort of content about real estate, the markets, the whole real estate industry as a whole, not just investing, but also things having to do with personal finance, be sure to subscribe so you don't miss any new updates since I post new videos every single week. I'll be sure to keep covering this issue with delinquencies and mortgage-backed securities and mortgages in general as we try to move through this real estate mortgage crisis. But in any event, to protect yourself, you might as well get a little bit of extra cash by opening up accounts using my affiliate links for Webull and Robinhood. If you open up accounts there, you'll get some free stocks. By just opening an account, you just put some money in it, and you can always take the money right back out, and you get your free stocks. And then you have a little bit of an extra cushion in the event that we go into a bigger crisis. But hopefully that will not happen, and we'll avoid this, and everything will be all right. But until next time, take care.